listed REITs versus private CRE returns in the first quarter of 2024, correlations between listed REITs and private CRE valuations, and the potential benefits of adding listed REITs to private CRE portfolios. That's what I'm watching this month. Welcome to the Real Estate Reel from Cohen & Steers. First, the NCREIF Odyssey Index, a measure of private real estate, has now declined in total returns for 6 consecutive quarters. The first quarter total returns of negative 2.4% broke down between capital returns of negative 3.3%, offset by income returns of approximately 1%. The NCREIF Odyssey Index, which as a reminder is an index that tracks 25 open-ended funds that own core commercial real estate, now has total returns of negative 18.4% since its peak in the third quarter of 2022. By comparison, total returns for listed REITs have risen 14.4% and have outperformed private as measured by the Odyssey Index by nearly 33% since that peak in private. We think this makes sense. We have long argued that listed REITs are a leading indicator for private CRE in both downturns and recoveries. Listed bottomed when private was still climbing in 2022, and now listed is recovering while private is still in the process of finding its bottom. This brings me to the second point I'm watching: correlations between year-over-year changes in listed REIT valuations compared to private CRE. Listed and private real estate returns tend to be correlated over the long term, reflecting the similar nature of the underlying asset class. However, in short time horizons, there's a clear indication of the lead-lag relationship between listed and private. Correlations of rolling one-year total returns between listed REITs and private CRE stands at just 16% since 1989, and they've turned negative recently as listed REITs rebounded while private real estate is still declining. However, correlations since 1989 rise to almost 60% when private CRE valuations are lagged just 3 quarters. In fact, most recent correlations in one-year total returns stand at nearly 100% when the NCREIF Odyssey Index is lagged for 4 quarters. The third point I'm watching is directly connected to this relationship. That is the potential benefits of adding listed REITs to a private real estate portfolio. By allocating to both listed and private, investors may smooth returns, reduce volatility, and mitigate drawdown risk. And since listed REITs have historically higher returns over the long term versus Odyssey funds net of fees, allocations to listed has historically increased annualized total returns of a blend of the two asset classes. This may seem counterintuitive at first glance, but keep in mind we've just discussed that listed REITs and private real estate are uncorrelated over the near term. One typically zigs when the other one zags, which can be used to an investor's benefit. The past couple of years bear this out. In 2022, private real estate rose while listed REITs declined. But in 2023, listed REITs rose by more than 10 percentage points, while private real estate was down almost 13%. Let's use an example, which you can see on the screen, showing returns of portfolios with a range of listed and private real estate allocations. Since 4Q89, a portfolio of 100% private real estate has generated annualized total returns net of fees of 5.8%, with a standard deviation of returns of 6.1%, and a maximum drawdown over that period of negative 38.6%. However, if an investor added just a 10% static allocation to listed REITs, annualized total returns increased approximately 60 basis points to 6.4%, while standard deviations of returns declined to 6%, and the maximum drawdown over that period was negative 35.4%. This is an overly simplistic example, and these metrics could be improved even more through active management of listed REITs. But we think it helps to illustrate that investors should embrace the short-term volatility of listed REITs as a diversification tool. Subscribe to the Real Estate Reel via the link on the screen and tune in next month to see what we're watching next.